Hi there, welcome to Kneppy Invest. Revenue growth. This is a really important financial metrics for most companies, and it is something I do focus on when I look at financial reports. So I'm looking at quarterly updates, which is focused mostly on cash receipts, and also on half yearly and yearly reports that companies do release. And right now we are in August, the second last day of August, and most companies on the ASX either release the half yearly or yearly reports. So I am focusing on looking for those companies that are providing a consistent growth in revenue over the last 3, 5, or 10 years. So I am not just looking at 1 year revenue growth, but I'm looking at the long term picture. So I'm going to bringing you quite a few companies over the next few months that have this at least a 10% growth in revenue over a certain period of time. And the company I'll be looking and focusing on in today's video is Breville. And this company has increased their revenue at 19% per year over the past 5 years. And more importantly, that revenue growth seems like it is accelerating. And there are a few exciting things about Breville, in my opinion. First one is they are accelerating their revenue growth. And I think one of the reasons why they are seeing an acceleration in their revenue growth is because of brand recognition, not only in Australia, but also overseas. So Breville manufacture appliances, and they do have a reputation for manufacturing high quality appliances. Now, you might disagree with that, but that is the reputation of this company overseas right now. And I think if this company can continue down this path of building their brand, building their name overseas, that is a very strong potential moat, competitive advantage this company could have over the next decade or even longer. And I think that is a distinct possibility that this company has, because one of the most powerful moats a company can have is brand. Just think of Coca-Cola. Think of Apple right now. Brand is one of the most powerful moats, and I think Breville is attempting to go down that route right now. So I'm very excited about the potential of this company over the next decade, even longer than that. Now to the financial year 22 results for Breville. And whenever I look at the results for a company, I have a cursory glance at the revenue just to see if it has grown from last year to this year. Now, 1 year growth in revenue or 1 year lack of growth doesn't mean anything. I want to look at the fuller picture, the longer picture, and we'll have a look at Breville's revenue growth over the past 10 years later in this video. But revenue has grown significantly, something like 20% from last year, up to 1.48 billion. Company was profitable to the tune of 105.7 million. But it's really interesting when you look at the operating cash flow. In fact, Breville was operating cash flow negative by 42.2 million. Now, if you just look at the cash flow statement in isolation, that could be a significant red flag, but it's not, because you also have to look at the reasons why the company was operating cash flow negative by a fairly significant amount. And to get a clearer picture of that, and I'll show you the clearer picture, you do have to go backwards, or actually forwards, because I look at the operating cash flow, or the cash flow statement first, and then I go back to the balance sheet. And when you look at the balance sheet, the reasons why this company was operating cash flow negative become quite clear. So we have a look at that in a few slides. Earnings per share, 76. So when you look at the earnings per share, 76 cents, and the share price 22.41, the valuation of this company is not too stretched. Now, one of the problems I've had with Breville over the past maybe 3 to 4 years is the valuation. And I think the market has been getting a little bit ahead of itself with the valuation and the share price. But the share price has pulled back. I think at one point the share price was well over $30. And then recently the share price actually dipped below $20 for a brief period of time. I thought that was a good time to take a position in this company, because the valuation, I think, was much better below $20. Now onto the revenue growth for Breville over the past 10 years. and this goes back to 2013. Now, between 2013 and 2018, revenue was growing, but it only grew from about 486 million to 646 million. But since 2018, we have seen revenue starting to accelerate. In fact, revenue has grown from 646 million to 1.4 million. And you can actually see that just in the compound annual growth rate in revenue by comparing the 10-year growth, 5-year growth, and 3-year growth. So over the past 10 years, revenue has grown at 11.3% per year. And that is exactly what I'm looking for. I am looking for companies that are growing their revenue at least 10% per year over an extended period of time. And 10 years is an extended period of time. But if we hone in and just look at the last 5 years, revenue has grown at 18.6% per year. And the last 3 years, revenue has grown at 23.1% per year. So this is a good sign moving forward for Breville. And it could be an explanation to why the market was giving a bit of a premium to Breville's valuation and why they were willing, or the market itself was willing to pay a little bit more for this company's shares, and why I got a little bit excited when I did see the share price pull back below $20. I'll just take a quick look at their cash flow from operations and net income, which is profit over the past 10 years. But we see the same trend here with Breville. Profit has been increasing through time. There's a little bit of lumpiness there, but not a lot. A little bit more lumpiness when we look at the operating cash flow. Most years, operating cash flow from operations has been positive until this year. So a significant change. And this is probably the thing that really stood out to me, is the very fact that this company was operating cash flow negative in this full year. So that's the one thing I want to understand about Breville moving forward. And again, we'll get the answers of that in the balance sheet. Before I have a look at the balance sheet, let's go to the statement of cash flows, because this is actually the first thing I look at. And then I'll work my way backwards. And we have seen a significant change in the operating cash flow of Breville from last year to this year. In fact, in 2021, they're operating cash flow positive by 124 million, this year negative by 42 million. The reason why I want to understand why this is important is if you go to the financing activities section, proceeds from borrowings 285 million, repayments of borrowings 116 million. So they actually did increase their loans, their borrowings over the past year by a significant amount. So almost 160 million. And that's why trying to understand why this company was operating cash flow negative in this particular year is highly important. So onto the balance sheet, and this is where we get the answers and why the balance sheet is important. The cash flow from the cash flow statement is important. Balance sheet is important. Profit and loss statement is important. The notes are important. Everything in the financial statements are important to get a good idea of how a company is performing. So in financial year 21, Breville was operating cash flow positive 124 million. And as I've mentioned, and as we've seen, in financial year 22, they're operating cash flow negative by 42.2 million. Now, in the cash flow statement, you get no idea of working capital changes. Now, the way the American companies do it, you do get an idea. So the cash flow statement for Australian companies is completely different than American companies. So in the balance sheet, we do get a sense of working capital changes. And typically, I just focus on trade and other receivables, inventories, which is in the current assets, and in the current liabilities, trade and other payables. Some people might just look at total current assets, the change in that, and compare that to the change in total current liabilities. So receivable changes, positive 74.8 million. Inventory changes, positive 229.2 million. Whenever you see receivable changes and inventory changes being positive, that is actually a cash outflow. So Breville has significantly increased the inventories from last year to this year. And we'll talk about this more over the next few slides, because this is an important change and a fairly significant change as well for the company. And for payables, that was down or negative 116.5 million. And that's the complete opposite. That's actually, when you see it increasing in trade and other payables, that's actually a cash inflow, not a cash outflow. So when you take all these changes in working capital into place, you go from being operating cash flow negative 42.2 million to being operating cash flow positive 269.6 million. But you also got to take into account the debt. There was a significant change in debt. You remember the last slide, they had something like $160 million of debt. So if you take that into account as well, this company was still producing money in their operations by taking into account working capital changes, by taking into account increasing debt as well by about $100 million. Now, sometimes a company will provide changes in working capital in the commentary or the presentation they do provide, and Breville has exactly done that in their slide, financial position at June 30. This particular slide I'm showing you now is straight from Breville's presentation, and they've got the working capital changes here. And so the working capital in financial year 21 was 160 million. In financial 22, it's now up to 348 million. Again, a significant increase in inventory, and they've also provided receivables and payables changes. And what I like to see is any commentary around why inventory has significantly increased from 1 year ago. And they do give some explanations, not only in the commentary in this particular slide, but elsewhere in the presentation, and also in the sort of the full-year results announcement that was about 5 or 6 pages. So when a company does release their financial year results, they've got the Appendix 4E, which is the financial statements. They also might release a presentation and also just a media announcement with it. So at least 3 announcements most companies do release when they release their financial results. So in this particular commentary, they've just mentioned here, supplemented by successful inventory pull forward to partially de-risk first half of financial year 23, normal September peak inventory now seen in June. So it does look like they've pulled forward their inventory buildup from September to June because of supply chain issues. They also mention in that media release, the group typically builds towards peak inventory in September, allowing delivery to customers in October and November to in turn meet peak seasonal consumer demand in November and December. Given the current supply chain risk of manufacturing shutdown and or transport restrictions, the operations teams has successfully landed a portion of peak inventory earlier than normal. So that's the reason why there is a significant, or has been a significant, increase in inventory this year. That significant increase in inventory more than likely will pull back next year. So the financial or the operating cash flow of this company for financial year 23 more than likely will be significantly higher than what it probably should be, just because of this pull forward in the inventory for this particular year. And you also can look at the inventory the company has at the end of the financial year through history. So this is the inventory the company or Breville has since 2012. And you can see a nice solid increase through time. So this is to our expectations until we get to this year where inventory has more than doubled. So this is unusual, what Breville has done, but I think they have explained it very well in their commentary and their media release. Something else I found fascinating within Breville's presentation is the amount of time and effort they gave to this inventory build-up. In fact, there was about 5 or 6 slides on this very topic, and that 5 or 6 slides started with this, and they raised the question, is $446 million of inventory high or low? And more than likely, what they were doing is they were just getting ahead of all the questions they thought were going to be asked to them after the release of these financial results. And I think they did explain it really well in the presentation. They explained that they were just bringing forward inventory ahead of schedule. They've also talked about the relationship between inventory levels and future gross margins. And they said there isn't for Breville. And they actually did have a nice little analogy here. What do a hammer, a Rolex, and a coffee machine have in common? All 3 are long life cycle, non-seasonal products with seasonal selling patterns. When was the last time you bought a Rolex at a year-end 50% off inventory clearance sale sponsored by Rolex? Never. So they are comparing themselves to Rolex. And what is Rolex? It is a high quality watch. So what they're doing here is being quite clever. They're comparing themselves to a high quality product. So they are saying we are also a high quality product, and high quality products are never sold at 50% off. So their main inventory takeaways, there was also a slide on this, and they're just talking about how they're bringing forward their inventory from September to June. And they're also saying that inventory levels are not correlated with future gross margins. Inventory levels, however, are perfectly correlated with future revenue if you run out of inventory, either because of demand or supply. They also mention here some retailers are reporting too much inventory, but it is not Breville inventory. We enter financial year 23 with all retailers having a proper channel weight, with the exception of a couple that are running light. So I think this build-up of inventory is not a bad thing. And the reason I'm talking about this is I did hear some commentary from some professionals talking about Breville being a sell now because of this significant build-up of inventory. And they think it is going to be a problem for Breville moving forward. Now onto some valuation metrics for Breville. P ratio 29.8, price to sales ratio 2.22, and price to operating cash flow negative because the company was operating cash flow negative for the financial year. Now, looking at the P ratio, price to sales ratio, or any valuation metrics in isolation at a particular point in time is quite silly. You've got to look at the historical ranges for a company over time, because some companies grow at a quicker rate than other companies. A PE ratio for Breville of 29.8 might be high or it might be low. So what I like to do is just look at the valuation or the PE ratio over time to get a sense of whether this company could be overvalued or undervalued based off historical ranges. So let's have a look at the PE ratio for Breville over the past 10 years. As we take a look at Breville's PE ratio over the past 10 years, the thing to take away from any sort of PE ratio chart, a long-term chart, is what's happening with the PE ratio over time. Is it increasing, decreasing, or holding steady? If it's increasing through time, that means there is multiple expansion happening. That's saying that the market is more willing to pay a premium for a company. Doesn't mean there's any justification behind it. It's just saying the market is willing to do that. If it's falling through time, the complete opposite. If PE ratio is holding steady through time, that's good. The market is not willing to pay a premium or a discount for a company compared to, say, 5 or 10 years ago. With Breville, definitely the PE ratio has been climbing through time. If we go back to 2012-13, the PE ratio of this company was between about 15 and 20. Now it's around 30. But the PE ratio of this company has been significantly higher over the past few years. In fact, back in 2020, the PE ratio of Breville was just under 60. So that, again, I think was a little bit too stretched for this company. So the reason, again, why the PE ratio has been climbing through time is because the market is more willing to pay a little bit of a premium for Breville. And one of the reasons the market is willing to pay a little bit more of a premium for Breville is because of the financial expansion the company has been experiencing. They're growing their revenues through time, they're growing their profit through time, and the market just likes the story. And that's the reason why I became a little bit excited about this company when you can just see the share price dropping, or the PE ratio dropped. In fact, the PE ratio dropped towards 20 at one point in time. So historically, when the PE ratio gets towards 20 for this company, that means there is some good value for this company at that point in time. Now to the charts for Breville. We'll look at the daily chart here going back to August last year. And then the next slide, we'll look at the monthly chart going back a fair while. So the main thing with Breville, and in my opinion, Breville is a high quality company. And for high quality companies, value is a much more important consideration than the trend in the share price or the sentiment. Now, the trend and sentiment is important, but not as important as value. So when I'm looking at a high quality company, value is the most important thing. And when the share price of Breville almost halved from $33.50 last September to $17 in the middle of June, this company did look much better value. Well, of course, it looked much better value, but it started to look really good value based off the growth and my projected growth of this company over the next 5 to 10 years. So that's when I decided to take a position in Breville back about a month or month and a half ago, when the share price got below $20. The share price has recovered quite nicely. Now, the main reason why the share price of this company has fallen a fair bit is just because the overall negative sentiment in the economy. And that's why it's, in my opinion, it's very important to draw up a hit list, a watch list of high quality companies that you want to buy when the value does become attractive. So I do recommend that. I have a significant watch list of high quality companies. And when I see the value of those companies become attractive, I will add to my position, no matter the trend in the share price, no matter the sentiment in that company at that point in time. Now to the monthly chart, and this monthly chart goes all the way back to 2012. So obviously a 10-year look at the chart, share price action of this company. And this is what we should expect because Breville is growing at a nice consistent rate year on year. In fact, you could say they're accelerating their growth over the past few years. So a company that is growing at a consistent rate over a 10-year period should see the share price growing at a consistent rate over a 10-year period. So if you take out the peaks and troughs as much as you can, which you try to do in these sort of monthly charts, you see the share price is going from the bottom left to the top right. If Breville continues to grow over the next 10 years, that's what we're going to see in their chart 10 years from now. The share price will go from the bottom left to the top right. So the company has to keep on growing for that to happen. And I'm fairly confident this company will over the next 10 years. That's all I have for this video on Breville. If you do have any questions about Breville, if you think or don't like the future of this company, I'd love to hear opposing ideas because that's how we learn as investors, to take aboard those ideas that are different from us and actually listen to them. Just don't ignore them. Listen to them and try to understand sort of the bull or the bear case as well as any bull cases. And I think those who are sort of negative about the future of this company, their bear cases are going to be much more interesting than any bear case from someone like me who is a little bit bullish about this future of this company. So if you are bearish about Breville over the long term, I'd love to hear your opinion on why. So leave that in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.